Hey everyone, Anthony Venuto here with InTouch Mortgage Solutions. It's Friday, Finance Fridays, and on this episode we're going to be talking about the Bank of Canada and their pause. Is it a pause or is it a conditional pause? Don't want to miss it, stay tuned. Earlier this week we heard from the Bank of Canada on January the 25th regarding its monetary policy decision to increase the overnight lending rate by 0.25%. And during that actual conference, we got to hear a little bit more about the Bank of Canada's decision to put a pause on these policy rates, although a conditional pause, and we'll get into that in just a moment. I want to take this opportunity and break down some of the major quotes and conversations that happened during that press conference, what we can take away from that press conference as Canadians, whether you're an existing homeowner, a potential first-time homebuyer new to Canada, and more importantly, what it could mean for the housing market as a whole here in Canada. Now, to kick off, for the policy rate of 4.50%, many economists believe that this is what is referred to as the terminal rate in Canada, being potentially one of the first to hit that point of where the Bank of Canada needs to take a step back and review their decisions that they've made over the past. Now, what do we mean by reviewing decisions that they've made over the past? And obviously, for many Canadians, we've experienced a Bank of Canada that's aggressively hiked interest rates, going from March of 2022 from 0.25% all the way up to 4.5% as of today, a 425 basis point increase, 8 consecutive increases in the last 11 months. This is obviously something that has moved very quickly. They've moved very forcefully, the Bank of Canada, to do that. And now they're getting to a point where they want to ensure that their decisions have not tightened the monetary policy. Over-tightening means if they increase their rates too much, they could definitely send the economy into a recession or cause significant damage. If they do not over-tighten enough, inflation will continue to be persistent and will continue to rise. Both things are what the Bank of Canada is diligently trying to avoid. Now, although the Bank of Canada and Governor Tiff Macklem have definitely been under the gun or under scrutiny for their inability to make accurate forecasts when it comes to transitory inflation and keeping interest rates at lower levels, the Bank of Canada has done a relatively good job in the recent times to provide the best forward guidance that they can. I just hope that this conversation around the pause that the Bank of Canada is indicating does age well, because obviously one of the major catalysts for the Bank of Canada to continue this pause is ensuring that all the data, all the cumulative data that they're collecting falls in line with their projections and forecasts. That is the key component here. It has to be a perfect storm in order for them to not raise interest rates moving forward.
If, on the other hand, we start to see an accumulation of evidence that inflation is not coming down in line with our forecast, we're prepared to raise interest rates further. I want to stress that this isn't going to key off one piece of data or one release. We're looking for an accumulation of evidence, and there. As you know, we follow a whole range of indicators.
Now, the likelihood of that is obviously something that is questionable. We don't have a crystal ball, and that is something that I want to bring to the attention of many Canadians. A lot of times we're getting calls right now talking about, hey, Ant, this is the policy rate, the Bank of Canada hit the pause button. And I'm like, although that is true, as I said, I have to take into consideration that based on the Bank of Canada's previous track record, I have to take that with a grain of salt and basically say, hey, there's still a potential that things could happen, things could change. And I want to take an opportunity and go through some of the conversation that happened with the Bank of Canada and Deputy Governor Rogers. First off, this is what the Bank of Canada came off with their statement, and I want to break it down a little bit more. Here it is.
Our policy decision today has two elements. First, we raised our policy interest rate by 25 basis points to 4.5%. And we are continuing quantitative tightening. Second, if economic developments evolve broadly in line with the forecast we published today, we expect to hold the policy rate at its current level while we assess the impact of the cumulative 425 basis point increase in our policy rate. We've raised rates rapidly, and now it's time to pause and assess whether monetary policy is sufficiently restrictive to bring inflation back to the 2% target.
So the Bank of Canada right here is talking a little bit about obviously the policy rate going up 0.25%, and they're also talking about quantitative tightening, something that we're very accustomed to. We've heard that multiple times since the rate hiking cycle has begun. Now, what happens is that the Bank of Canada has a series of bonds on their balance sheet, and now instead of renewing them or purchasing them, they're letting them roll off, mature, and they'll basically go back into the market. This has definitely a reactionary, it causes prices to change when it comes to fixed rate mortgages, as bonds, the Canadian bond market, the government bonds have a direct correlation with the 5-year fixed, for example. That is something that has a direct correlation and something that we should be paying attention to moving forward, especially for Canadians who have mortgages and that are approaching renewals. Obviously, as we see the bank's policy rate increase or maybe hold, the bank's prime lending rate, which is now skyrocketed to 6.70% and higher if you have a line of credit, depending on if you have a discount on your variable or if you have a plus adjustment factor on that line of credit, obviously has gone up, which might be definitely enticing Canadians to opt into a shorter term fixed rate product or go into a fixed rate product for qualification right now. Obviously, one side note is that as we start to experience what happened over the last 8 consecutive increases, many Canadians are going to have a very bad taste in their mouth regarding variable rate mortgages, and rightfully so. Obviously, having this conversation about variable versus fixed will be a little bit more interesting moving forward. One key conversation that came up in the conference that I found very interesting was one of the members of the press asked them about rate cuts, or that Bay Street is pricing in price cuts at the end of 2023. And interesting enough, this is what the Bank of Canada governor had to say.
Conversations on Bay Street have already started about interest rate cuts. What are the parameters for such a cut? And do you think these Bay Street observers are getting it wrong by discussing such a shift at this stage?
I think it's far too early to be talking about cuts. Look, inflation is still above 6%. Yes, recent developments have reinforced our confidence that inflation is coming down, but we have a long way to go to get back to our 2% target, and we are resolute in our commitment to get all the way back to 2%. As I've indicated, we're talking about a pause, and the pause is really a period to allow us to assess whether we've raised interest rates enough to get inflation back to target. We're trying to balance the risks of over and under tightening. We don't want to underdo it, and then inflation stalls on the way down. So, to end off where I started, it's way too early to be talking about cuts.
Obviously, it is way too soon to even consider or think about rate cuts from the Bank of Canada. A lot of the conversation around that is what will have to happen. Remember, all the data has to be taken into consideration. So I always pose this question: what do you think would have to happen in the Canadian economy at the current levels for the Bank of Canada to even consider a rate cut in this environment? That is a major question. Let us know in the comment section below what you think. And as we continue to cover the Bank of Canada policy rate decisions moving forward and what it could mean for the housing market, that's the type of content that you enjoy. We invite you to hit the like, share, and subscribe button and that notification bell so that you can get notified every time we post a new video. Now, what are some of these questions or some of these actual indicators? One of the press members did ask that question, and although it's multifaceted in the sense that there's so many different components, so many different charts, if you have a chance to read the boring monetary report like we do, then you'll start to see all the things that they're looking at. Now, one of the existing ones that we've seen since the beginning of the war in Russia and Ukraine is obviously what is happening overseas. Arguably, that is a major concern that has been with us for some time. But one that emerged very recently is the fact that China is going back online after a series of significant lockdowns and very strict measures. This could have definitely an impact on the global economy when you look at commodity prices, oil, and obviously global growth, as they are a major consumer importer and exporter. So obviously that is something the Bank of Canada is going to be paying close attention to. The other thing is obviously the GDP, the growth over the next few quarters, where the Bank of Canada is projecting the growth to be, where it's going to stall a little bit in 2023 and hopefully rebound in 2024. That's very important. They're also looking at inflation expectations, something that you may have heard of, something we've talked about. That is basically buyer sentiment or consumer sentiment. Over the past few months, we've seen where the inflation numbers were so high that Canadians were under the impression that if they didn't buy these big ticket items, appliances, cars, and furniture at the prices that were then, that the prices now would have been more expensive. But now as we start to see some of those pressures roll off as inflation has peaked, many Canadians believe that inflation will come down and that they're putting off a lot of those major purchases, as that's translated into the data that household spending has come off significantly. Arguably, that is also because of the cost that Canadians are incurring, not only for rent, but to service their mortgages and their debts as interest rates have risen. There's just not a lot of money left over for these extra items, leisure items, entertainment, and, travel, so on and so forth. So that is something that as Canadians continue to experience these hardships as a result of higher interest rates, that the Bank of Canada is paying close attention to as well. Where do you think inflation is headed in the next few months? Do you think we're going to see a resurfacing of inflation, or are we going to start to see it come back down significantly? Not just headline inflation, but core inflation. A lot of conversation around stripping away things like food and shelter. Where does that leave inflation numbers, around 5%? If that number starts to increase, what will happen next, right? So obviously only time will tell. We're just as open to suggestions as the Bank of Canada is to reviewing their data. And ultimately, the other component is labor markets, right? So what is happening in the labor markets? As of December, we saw obviously the 104,000 jobs. We saw that it is tight. We obviously have to take into consideration that there is new immigration, new permanent residents that are going to be statused in here in Canada. And what does the labor market mean? Obviously, the Bank of Canada, who's under the gun for wanting to see unemployment rise and Canadians, unfortunately, to lose their jobs, or these vacancies, these job postings by businesses to come off. And as the cost of borrowing and for businesses increase, a lot of businesses aren't going to be reinvesting in their businesses or hiring new employees. They're going to try potentially to keep their existing employees. That's also a concern for the Bank of Canada, because if, for example, the recession is, let's say it arrives, if it's temporary, if it's technical, if it's long or short, if it's a short recession, many businesses, because of the fact that they can't find so much labor or skilled labor, they might end up keeping their employees and having to pay them a little bit more, which is referred to as the wage spiral, where they're seeing wages increase 4 to 5%, which is definitely in contradiction to inflationary numbers, right? So if you're paying people more, that definitely has a reverse impact on inflation. So that is something that the Bank of Canada is paying very close attention to. And ultimately, the question in a lot of people's minds is what was said about the housing market. Well, obviously, the housing market is a big ticket item in regards to cost to purchase a home, the cost to service those debt loads, and the Bank of Canada has signaled that there is still room for the housing market to come off a little bit more, obviously from its peak that we saw in early 2022. Unsustainable, something that was, even we said during that period of time, this cannot progress at this level. We always consider the housing market like a tree. It should grow a couple inches, not a couple of feet. And obviously there is significant pressures on there. But what was interesting was what Carolyn Rogers had to say about the housing market. Here it is.
The housing market's evolved broadly in line with our expectations. As you've mentioned, it's come down, activity's come down significantly, and prices have come down as well. It's important to remember they've come down off extreme highs. We saw a real run-up in prices and activity during the pandemic. That was an unsustainable level of activity. It has come down since then. We do expect, as we outline in the NPR, that pullback will continue in the first couple of quarters of this year. But as you also pointed out, there are some fundamentals that we think will lead to a pickup again later in the year. Immigration is picking up again. So we do expect housing to come back. And you are right, housing costs, mortgages are priced off the bond market in Canada. So as those prices stabilize and come down a bit, we should see that show up in the market. that may have some help in a rebound, but we do think there is a little bit further to go for the housing market to come down a bit.
Now, do you agree that the housing market could rebound at the end of 2023? What types of conditions would be required in order for us to see the housing market rebound the way the Bank of Canada is indicating? Now, obviously, this is a major conversation as we're starting to see that many Canadians hear the pause, forgetting the conditional part of it, they might resurface into the housing market, which obviously is something that is important. If you're looking to purchase a home, we do have a lot of clients that are reaching out, and from our data analytics that we're looking at, the majority of them are from 25 to 35 years old, who've put their buying decisions on hold over 2022 because of the volatility and obviously uncertainty in the housing market. And now as we start to get some indication that there might be some normalcy hitting or some neutrality, that's probably a better word, in the market, that many Canadians might begin to get back out as home prices are significantly lower. Obviously, that is something that we hear from our clients, not something that we're pushing or propagating to our clients. It's just literally if you qualify and you want to take a look at taking advantage of some of those deals, something that is very, very important. And obviously, when we look at the Bank of Canada as a whole, as I mentioned at the beginning of the video, it's very important to understand that they have made some errors. They are trying to redeem themselves. I just take an opportunity to take what they say with a little bit of a grain of salt, basically take a second to dissect what's happening and look at it from our perspective. But more importantly, I hope that everyone enjoyed the video, and I hope you learned something today that you didn't know before you watched this video. But we'll leave the video here. We hope that everyone had a great opportunity here today with us, and we'll leave it here wishing everyone a great Friday. Thanks for watching, thanks for clicking, and we'll see you next week.